One of the best times to buy your favorite stocks is when they don't go down on bad news. Now, why does this happen? Why do some stocks not go down on bad news, like when they miss earnings or when they announce a product delay? Why does that happen? It's because sentiment is so negative on the stock that all the short-term investors that wanted to sell a stock have sold it, or, and I saw this when I'm about to tell you a lot in the hedge fund industry, if a stock goes up on bad news, it's actually because too many hedge funds are short it and they freak out that the stock is not going down on bad news. So what they do is they buy the stock quickly in order to cover their short position. Because with a short, your losses can be infinite if the stock goes up a lot. Now, if you want to short stocks, I recommend buying puts instead, which is what I'll be teaching in my upcoming complete options course, which I hope you enjoy. So how do you know when stocks have way too many short positions in them? Well, I'll show you. The metric we're going to look at is called the short ratio. And let me explain this to you using Yahoo Finance. Okay. And never pay for any investment advice, please, when it comes to finance websites. So we'll go here together to finance.yahoo.com. And what I'm going to do is I'm going to show you a stock that I don't know that much about, but I thought it'd be interesting to chat about, called GoGo. Okay. And what we're going to do is we're going to look at the short interest ratio, and I'll show you how to calculate that as well. So what we do is we go down here to statistics, and then we scroll down to the short interest right here. Okay, the share shorts. Okay, so what we do is we take the number of share shorts and we divide it by the average volume, which I'll show you in a second. So 14.6 million shares short in this stock. And I'm going to look to see what the average daily trading volume is. Alexa, what is 14.6 divided by 1.3?
14.6 divided by 1.3 is approximately 11.2308.
Okay, great. Now, that's 11.23 days to cover. Okay, so what we just did there was we took the number of shares that are shorted for the stock, and then we divided it by the average number of shares that trade per day. And what that does, it tells us how many days of volume on the stock would it take to have all the shorts give up and get out of the short position. And the metric I usually use is over 10. If it's over 10 days to cover, then I usually don't make it a very big short position unless my conviction level is very, very high. And when it comes to hedge funds, they all follow each other as part of the hedge fund mafia. And many of them, what they do is they put on the same short positions. And then they all freak out at the same time and they cover their shorts that don't go down on bad news. And the inverse of this is true as well. Meaning, if you own a stock and it just won't go up on good news, then it could be a crowded long position. And so in conclusion, with Reddit investors, their favorite strategy recently has been to look at what stocks hedge funds are short in size. And then many Reddit investors get together and they buy a lot of shares in that stock, which pushes the share price up, of course. And this makes hedge funds freak out because they have to cover their position because their shorts are actually going up on no news at all.